It is all about inflation. Oil touched $139 a barrel, nickel dropping $100,000 on the LME. Everything from energy to metals to agricultural products have been surging, begging the question, how will global policymakers respond? Will they prioritize economic growth amid elevated uncertainty, or will they choose to tighten even faster to contain inflation? Well, Nur Shamsiah Mohammed Yunus is the governor of Bank Negara Malaysia. Benjamin Diokno is governor of the Philippine Central Bank. Thank you both for joining us today.
Thank you, Haslinda, and greetings from Kuala Lumpur. Well, the conflict in Ukraine is a real tragedy. So it does add a new source of uncertainty to the global economy. So thus far, the conflict, as what you have said, has led to a surge in commodity prices. And this could weigh on global economic recovery amid the backdrop of rising global inflation. So events continue to unfold. So at this juncture, it is still early to definitely size up the total impact of the conflict to our economy. What we know is that there are multiple channels at play, including trade, prices, and financial markets. So the extent of the impact of the conflict on the global economy and financial markets, and thus on Malaysia, would depend on, firstly, I would say the length, breadth, and depth of the conflict. Secondly, the extent of financial and the extent of what I call economic and financial countermeasures. And thirdly, the policy reactions by relevant authorities. Malaysia, we are a net commodity exporter. So while we would be affected by lower global demand through lower exports, we do stand to benefit from the surge in commodity prices. But at the same time, further increases in commodity prices over a prolonged period would pose an upside risk to inflation. But policies in place by the government to contain excessive price pressure would somehow cushion the spillovers from these cost push factors in the short term. But over the medium term, we could see international trade and global manufacturing also being redirected to the region. And in terms of financial markets, adjustments following tightening financial conditions have been orderly so far. The removal of Russia from emerging market indices such as FTSE, MSCI may lead to rebalancing of global portfolios into the region. So any spillovers going forward, including adjustment in our domestic equities market, while we have this synchronized global risk aversion, would be mitigated by the resilience of the economy, the financial system, and the ample liquidity that we have in our financial market. So we do expect Malaysian economy to remain on its recovery path for inflation. Like what you have said, Haslinda, we remain vigilant of second-round effects. Although we have not seen any broad-based above-average price increases, we are also not seeing weight pressures that are excessive. So longer-term inflation expectations currently remain anchored. So we will continue to closely monitor the situation to assess the implication on the overall outlook for domestic inflation and growth.
Governor Diokno, we know that a lot of factors are in play. If you take the commodities alone, oil, I mean, we have JP Morgan saying that oil will get to $185 a barrel by the end of the year. Is the oil shock of 2022 likely to be deflationary in the longer term? Is there a real risk of a global recession?
Before the Russian invasion of Ukraine, we were doing very well on the inflation front. Our inflation performance in January and February is 3%. That's within our 2 to 4% target range. Now, because of what happened, I think, and precisely because of the oil, because the Philippines is an oil importing country, totally depend on imported oil. So things have changed, but as Shamsiah said, this is early. There's highly uncertain times. So what we can only do at this time is do some price simulation, and based on our oil price simulation, inflation could still settle above the target range of 2 to 4%, only if crude prices average higher than $95 per barrel. Okay, $95, that's the threshold. Below $95 per barrel, inflation would settle within the target range. The highest ever value of Dubai oil, which we use, was recorded in 15 July 2008 at 141 US dollars 33 cents per barrel. Now, should the worst case scenario oil prices reaching 120 to 140 per barrel on a sustained basis, not just 1 day or 2 weeks, 120 to 140 pesos per barrel, dollars per barrel, inflation would be 0.7 to 1 percentage point above the baseline. In brief, inflation would average between 4.4 to 4.7% under the worst case scenario.
Governor Shamsiah, earlier you talked about how Malaysia is an oil exporter, so it is benefiting from higher oil prices. But the thing is, when you take a look at businesses, they are rushing to pass on the cost to consumers. If a doll, which usually costs $10, now costs $25, what would it mean for consumer sentiment? What would it mean for growth? How are you looking at it?
Well, like I said, there are many channels at play. Yes, we do have the pluses and the minuses. The pluses would be, higher income that will accrue to the commodity exporters, and that will cushion. And the other channel that I had mentioned would be through higher input prices that may affect production and investment, and thus, lead to higher inflation. But we also have continued slack in the economy and the labor market, and that will partly mitigate the upward pressure on inflation. So this is a very fluid situation that warrants a lot of monitoring, engagement with the industry to make sure how this price dynamics would affect their pricing and how it will affect, whether it will affect demand, whether it will cause excessive demand in the short term that will require some response. So this is something that we will continue to monitor and be vigilant against.
Governor Diokno, earlier you talked about how you'll start worrying about inflation when oil exceeds $95 a barrel. I want to point you towards the bond market. If you take a look at the spread between treasuries 2s and 10s, it's collapsing, suggesting that we're looking at perhaps a slowdown, even a recession. Is the bond market wrong in predicting that?
Well, I think there is a tendency to overreact under these certain conditions. So I think it's better to be level-headed, be rational, and we don't know whether this will last a few weeks, a few months, or a year, or more than a year. So I think, as said before, we just have to monitor the developments. There are many things happening, of course, right now. In addition to the Russian invasion of Ukraine, you have what is already accepted, the normalization that will take place in the US. The Fed will adjust the rates, so that also affects everything. So this is a combination of lots of factors, okay? And so plus the uncertainty, and so it's magnified by nervousness on the part of some players. But I think the right thing to do at this time is be cool and assess the situation.
As you remain cool, Governor Diokno, I'm just wondering whether you've reassessed the number of times the Fed is likely to raise rates this year. When I spoke to Governor Periwarjio, he says he maintains it'll be 3 rate rises for 2022. What are your thoughts on that? Has Ukraine changed that? Has the fallout in the equity markets changed that?
I think the Russian invasion of Ukraine and the uncertainties that it has developed, yeah, is certainly going to change the mood among the Fed members. I think instead of maybe a 50 basis point adjustment, it could be just 25 basis points. Instead of 5 adjustments, it could be 3. So we don't know. So we are waiting for the action, and that's why I think it's necessary to be patient. And on our part, we will be patient. And that I noticed that among Asian countries, we're not like the Latin American countries and some European countries. They already adjusted upwards the rates, except for South Korea and New Zealand. I think most Asian countries have not yet adjusted the rates.
Governor Shamsiah, what assumptions are you making about Fed moves in 2022?
The prolonged conflict in Ukraine does pose considerable uncertainty to the global outlook and the commodity prices. And as I see it, this will add a layer of complexity to the decisions of the central banks. So, but nevertheless, when we look at the spillovers to the Malaysia's domestic bond market and FX markets, the adjustments that we have seen so far, and more importantly, the impact of these adjustments on financial intermediation and the Malaysian economy, we do expect it to remain manageable for a variety of reasons. We have worked very hard since the Asian financial crisis, in fact, to have a deep and liquid local bond market. So the diverse investor base will continue to support orderly conditions, and more importantly, to facilitate price adjustments in the market. So with the economy on an improvement track, so any temporary adjustments to the bond yield should provide a good buying opportunity for investors. We also have a financial system where banks are the main where banks rely on deposits instead of the bond market to fund their financing activities, and they play a dominant role in financing economic activity in Malaysia. About 75% of financing in the economy are granted by the banks. So although we have a situation where the borrowing yields may be going up, but it will not translate into higher cost of funds for the banks. So these are some of the factors, Haslinda, that we think that volatility is going to be a given. But I think the efforts that we have put all these years to deepen the onshore market, the bond market, the FX market, and the range of hedging instruments that we have been working very hard with the investors to provide onshore so that they are able to manage the FX position, that will provide some what we call factors that will mitigate some of the spillover impacts and ensure orderly market conditions.
Bank Negara reviewed its policy recently, and it said that the war in Ukraine has emerged as a key risk to global growth as well as trade. What does it essentially mean in terms of monetary policy for you? Will you be holding rates longer? Will you, as Governor Diokno said earlier, remain patient?
Right. Well, the MPC conducts its monetary policy premised on achieving price stability and sustainable growth in Malaysia. So all these global developments are assessed through the lens of whether they affect the balance of risk to inflation and our growth outlook. And this is something that the MPC will continue to be data dependent and be vigilant on the recent developments and how it affects the balance of risk.
You stood pat for a long time now, in fact, since July 2020. And Alice, we spoke to say that they're expecting normalization to start in the second half of the year. Is that a fair assumption, you think?
Well, this is something that we'll continually assess. I mean, I can't preempt the MPC, but this is something that we'll assess. The economy is on a firmer growth path, and we will continue to assess, what would be the appropriate degree of monetary policy accommodation that to make sure that this economic recovery is much more durable moving forward, while ensuring that inflationary expectations remain anchored.
Governor Diokno, might you raise your key rate, Elliott and plan? Because we know that you've said before that you'd like to see perhaps 4 to 6 quarters of steady growth, 5% unemployment. What might prompt you to change your mind?
Well, as you know, the economy grew at 5.6%. That's more than the expectation last year. And assuming that we meet our target this year of 7 to 9%, then I think we're still on track. We plan to adjust in the second half of the year. But as I said, we have already started the process of reducing our accommodative policy and winding our policies. For example, previously we lent to the national government something like 540 billion pesos. That's equivalent to 10.5 billion US dollars. That's interest free during the height of the COVID. Now recently it has been reduced to 300 billion US dollars, rather pesos. That's 5.8 billion US dollars. And we expect that to be down to zero by the third quarter of this year. Now on the government, on BSP's purchases of government securities in the secondary market, that has also gone down. During the first year of the crisis, 2020, we bought something like 19.4% of the total GS portfolio. It's down to 4.8% in the second year, 2021, and now it's down to 0.7%. So we have started the unwinding, and but on the policy adjustment, we plan still to do that on the second half of the year.
So no risk of being behind the curve, yeah, Governor Diokno?
No, I don't think so, because I think the Philippine macroeconomic fundamentals are really sound. And so, for example, if the Fed normalizes, we are supported by a strong external buffers. Our gross international reserves is equivalent to about 10.2 months of imports. And the received doctrine is 3 months worth of imports is sufficient, okay? Plus, we have a steady inflow of foreign exchange from our overseas Filipino workers, from the business process outsourcing, and our FDIs was fairly robust last year. The foreign direct investment grew by 52.5% last year, just from January to November, and that's more than what we got before the crisis. And so we expect FDIs to continue, especially we have passed the recent legislation that will open up the economy. So I keep saying this, that despite the pandemic, we continue to focus on the structural reforms that are needed to make the Philippine economy more competitive.
We can't talk about the global economy without touching on China. Governor Shamsiah, China has said it wants to grow at 5.5% in 2022. Is that enough to offset any drag from the war in Ukraine? Because JP Morgan has come out to say that, you know what, Russia's invasion of Ukraine will shave off around a percentage point from global growth this year. Is China enough to offset any drag there may be?
One thing good about Malaysia is, the diversification of our export markets and export products. So while, one country may suffer, disproportionately from the high oil prices and growth, there will be other countries that will benefit from that. So in terms of the growth, the weighted trade growth of our major trading partners, because of the diversification, the impact to Malaysia would be somewhat mitigated. So, and exit that. So we are not just diversified in terms of the countries that we export to, even in the products. So there are certain products will benefit from the current unfortunate events that will, drive more demand, for example, and there will be other products that, they would suffer disproportionately from the supply chain disruption. So net, again, the situation is still fluid. So we need to, assess all these events and how it will affect the Malaysian economy and the financial markets.
Your thoughts, Governor Diokno? Do you think China can perhaps offset?
You mentioned China because while a great majority of countries have already adjusted to maybe is in the process of raising or tightening. China, on the other hand, is the outlier. I think they even cut their policy rates and their reserve requirement. It is as if they cannot afford to have a single-digit growth. They're still growing, but it's much slower than they're used to double-digit growth, and they're not happy with a single-digit growth. I don't know whether they will succeed given the new environment, but as noticeably, it is the outlier.
Could China be a bigger risk than Russia's attack on Ukraine, you think, Governor Diokno? Could China be the risk?
I think so, because it's more connected with the entire world rather than Russia. I think the contribution of Russia to the global economy is much less compared to China, and so a slowing China could have a bigger risk than the current war right now in between Russia and Ukraine.
For Asian economies, for Southeast Asian economies, the currency stability is very important. The peso, Governor, recently broke a threshold of 51.50 to the dollar. How is peso weakness factoring into your policy outlook?
We continue to pursue a market-determined exchange rate. Our macroeconomic assumption, we're not targeting, but our macroeconomic assumption is that the peso will be between 48 to 53 per US dollar, okay? Now it's moving, but I would attribute that to the global uncertainty. We are confident with the current level of we're confident that we can address the volatility because, number one, as I said, we have a flexible exchange rate system. So we allow the peso to seek its own level. We only participate if there are huge fluctuations, because that could be a threat to our inflation targeting objective. We have existing liquidity enhancing and management tools, such as the US dollar repo facility, exporters dollar and yen rediscount facility, and the enhanced currency rate risk protection program. We have not used this for the longest time, but I hope we won't use them also. But as I said, in addition to the huge or to the hefty gross international reserves, we have a constant inflow of foreign exchange from our overseas Filipino workers. It grew by 5% last year, despite the pandemic. The overseas, the receipts from BPOs and also from our exports. Exports was also robust.
Intervention is still an option, Governor, because you've said before, you told us, in fact, in January, that the bank would look to intervene near 51.50. So intervention is an option for you.
We participate if there is a huge fluctuations. I must admit, when it was moving towards 48, we have to intervene. We don't want the peso to be so strong, because that will not be good for our overseas Filipino workers and our exporters, all right? So we just intervene if there is a need for it. But by and large, we allow it to seek its own level.
Governor Shamsiah, we heard from Khazanah saying that Russia's stock outflow will probably land in markets like Malaysia, like Indonesia. How do you think that might play out in the Malaysian ringgit, in the Malaysian economy?
there will be rebalancing of portfolio because of the removal of Asia. So for index trackers, for example, they may then rebalance their portfolio to mirror the weightages in the indices. So I think the region as a whole would benefit. In terms of what we have seen so far is still continued inflow. Last year, for example, we had an inflow of about $8 billion US, and year to date, we have been receiving inflows of about $2.3 billion US. And the volatility in our ringgit has been, much lower than what it was in the past. And for example, I have the numbers here where the 1 month implied volatility of the US dollar against the ringgit is around 4.2 versus the 5-year average of 4.6. So the market has been quite orderly. And the other thing that is benefiting Malaysia is we do have a pool of strong domestic institutional investors that can act as a shock absorber also if there are outflows in the country. And these domestic institutional investors do have the capacity to absorb the market. And more importantly, just like what Benjamin had said, for Malaysia, the exchange rate has been acting as a shock absorber. And that will insulate the impact of any volatility on the domestic economy.
Just one final question before I let both of you go. Perhaps you can start off, Governor Diokno. What do you deem as the biggest risk for 2022? What keeps you up at night?
Wow. I think still cybersecurity rather than anything, because we have embarked on a digitalization journey. And so, and it has succeeded, but it of course carries with it that risk. Okay? So that keeps me awake at night.
Governor Shamsiah?
We are on a similar mind, Benjamin, that you're talking about the tail operational risk that any models will not be able to predict, and having that kind of disruptions to the financial system and the economy. So cyber risk would be one of the things at the top of my mind.
Governor Nur Shamsiah and Governor Diokno, I thank you so much for your insights today. It's been a pleasure. It is a challenging time for all central bankers right now. Thank you.